Welcome to Macro Insight. This is my weekly call where I take you through my thoughts on all of the different asset classes out there, which trades I'm looking at, what the main market drivers are and narratives, and how I'm risk managing my positions. If you haven't already signed up to your free 1-week trial, please visit the website link in the description to this video, and that will give you access to the live call with me, and that takes place on Tuesdays at 2 p.m. London time. Hopefully I'll see you there next week.
Welcome to Macro Insight. Today is the 26th of January. I want to thank all the new subscribers and trialers. Welcome. It's good to have you here. And let's take a look at the markets. So first of all, we'll talk about what's been going on in the news, what kind of the main story has been over the last sort of week, and what's been going on. So we've got the US stimulus bill, probably the main thing that's been driving all this bullishness in markets recently. So that still needs to be passed. We had some resistance from the Republicans. Obviously 1.9 billion has been the number that's been touted around, but there's potentially going to be a delay getting that thing through because you've got Trump's impeachment trial to happen first. So now it's looking like the next round of relief may not happen until middle of March. And it may be reduced to closer to 1 trillion. So you've got major banks like Goldman's and JP who analyze this stuff in great detail. They're expecting it's much more likely that there's going to be around 1 trillion only. I know that doesn't sound like an only, but 1 trillion only when the market's expectation is double that. And it's going to be targeted focus on the devastated or the most devastated consumers and small businesses. Okay, so when that kind of started to come out yesterday, the market did have a bit of a dip. So you can see, if we go to the candle for yesterday, we dipped all the way down to 3,800 on the S&P, but it didn't last. The market got bought straight back up, and the candle kind of finished pretty close there on the day. Okay, so that's kind of what drove that intraday price action. In other news, you've had the EU vaccine rollout has been pretty slow and disappointing. So AstraZeneca talking about delays getting the drugs over to where they need them in Europe. You've also got kind of the EU threatening to impose export restrictions for vaccines that are coming from EU, made in Brussels to get to the UK. So, a bit of friction kind of building there between the countries, and the rate of vaccine rollout's not really what people had hoped for. So you've actually got, of the developed nations, you've actually got the UK doing pretty well. They vaccinated about 10% of the population, whereas US is about 7% and Europe's nowhere, right? So Europe's kind of looking at 2.5% in Spain, and everywhere, all the other major European countries aren't even at 2.5%. So going a bit slower than maybe the market is pricing in, given the bullishness that seems to be in markets. Yeah. You've also had the Italian Prime Minister Conte resign. There's obviously a vote of no confidence there, and he's resigned. More sort of political conflict and upheaval. It wasn't unexpected by the market, so you haven't seen a massive negative reaction there. But just something to keep an eye on. Some of this Italian politics does sometimes take the spotlight and create a bit of turbulence in peripheral markets in Europe, like Spain and Italy. So something to keep an eye on that may be bubbling there. In terms of virus mutations, they've been growing worldwide, it seems. That's also bringing into question some of the long-term effectiveness that these vaccines may have. So again, this whole premise of bullishness in the market and the reflation trade, and why all these asset classes are at all-time highs, well, not all the asset classes, but certainly equities are all-time highs, are built on the idea that a recovery is coming, and that recovery is coming because the stimulus that will be passed to plug the holes and cushion the blow to the economy over the next few months, that will do its job, and then the vaccines will do their job, and the world will restart. Now, we're starting to see, if there's mutations popping up all over the place, and the vaccines are not as effective against those, and the vaccine rollouts are not happening at the pace that you would have expected, then there may be a need to reprice the market's expectations at some stage in the coming few months, basically, right? So that's that would probably be the thing that could shake this narrative that is driving the market higher at the moment. Okay, so that's kind of what's going on in news. In terms of actual markets, you know, the NASDAQ has probably been the leader of late. So it had a bit of weakness maybe a couple of weeks ago, and it's recovered pretty strongly off there. So NASDAQ got to about 12,750 and rallied all the way to new highs at 13,500. So that's interesting, just because obviously valuations in tech are already so high. People had been talking about the value versus growth rotation trade and stuff like that, whereas the tech stocks are saying, no, we are participating in this rally, right? If you want to go up, you're taking us with you, basically, right? So NASDAQ kind of still charging higher. That's also echoed in kind of other tech space. If you look at China, for example, China and EM markets in general have been doing very well. So for China, you can look at this FXI ETF. This is, you know, a good one to have a look at. You've also got the K-Web, which is the kind of internet sector in China, and that's been absolutely flying, right? So it had a period of consolidation in December. That was a nice opportunity to get into that, and it's had a really, really strong rally off there, and it's kind of gapping to the upside, right? So it's picking up momentum as we rally. So this is not the type of stuff you want to be selling into when something's gaining momentum as it's breaking higher, basically. Yeah. So very strong there in tech space. I would say the intraday price action though has been quite choppy. So, you know, the bad news the news that wasn't so great on the stimulus front, knocking quick 2% off the S&P intraday and then rallying back. That is not a sign of a particularly healthy rally, right? It's not a sign of a market built on healthy foundations when it can just like gap down 2% on that sort of headline, right? So those are the things that, you know, often when you see higher intraday price volatility, that can often be a precursor of some broader market volatility, because it's telling you that there's not as much equilibrium in the market, right? Market can very quickly change its mind and go from everyone wanting to own it to everyone wanting to dump it, basically, right? And maybe that's also a sign of a lot of the marginal money that's driving markets is retail money, right? It's money that's quite skittish and is getting in and out quickly and will react to a headline, basically. It's not necessarily real money that's in it for a longer time horizon that is comfortable, basically, right? So that's what that intraday price actually kind of shows you. But talking more about that kind of crazy retail money that's in there, the high speculative, high short interest names are just going crazy. So I'm going to show you a couple of charts of some of these names. You've probably seen it in the headlines. It's all over the place recently. Gamestop was the big one yesterday. So Gamestop is like a computer game, you know, bricks and mortar shop, basically. And you know, some smart money hedge funds have been shorting it quite heavily, right? So they think, you know, with the whole e-commerce growth and what's happened with the virus and shopping malls, you know, getting decimated, things like that, that this stock was very overvalued, right? So and the future for this stock was not very good. So hedge funds started shorting this quite aggressively to the point where the short interest in this name was 140% of the actual shares outstanding, which is quite exceptional, right? You don't generally get short interest be over 100%. So that's kind of the setup that was in the stock. And now the retail army, as I like to call it, is all these millions of people who are now just started trading last year. A lot of them use the Reddit forums, and there's a forum called WallStreetBets on that Reddit forum. And they have been going after certain stocks and agreeing between themselves that this is the stock we all want to buy. And they're kind of all jumping in it together, basically, right? And that is creating, at the margin, quite an enormous demand for this stock, which is not a particularly large cap stock. So they're picking their names that they want to go after, their story stocks, let's call them, or meme stocks that they're going after, and they are ramping these stocks up like one by one, right? So GameStop is the one that has hit the headlines recently because it actually managed to rally 150% intraday yesterday, right? And that's having already gone. Last week, it went from about $20 to $70. So it already tripled last week. And yesterday it managed to do 150% intraday, got to highs of around $160. As you can see that high tick over there on the candle, and then it finished the day down. So that's quite a big rejection candle on that stock, and maybe we've seen the end of it. But the fact that it got up to 160 was because the shorts were getting squeezed. And, you know, I don't know if you all understand how that works with shorts getting squeezed, but basically shorts have to borrow the stock from someone, okay? And sometimes that borrow can get called, and also they're just losing too much money because this stock just keeps going up, and it's unlimited how much they can lose, right? It's not like when you buy a stock, it's limited because it can only go to zero. When you sell a stock, there's no limit to how high it can go, and it's going. And part of the reason it's going is that the retail army, not only are they buying the stock itself, they're also buying call options on the stock. And by buying call options on the stock, they're creating a bit of a kind of feedback loop that forces those sellers of those options to buy the stock if the stock rallies, and it fuels that demand, and it makes it become a bit self-fulfilling, basically, right? So that's kind of what's been going on. I mean, the hedge fund that's been in the press was called Melvin Capital, and they lost about 2.75 billion on it, to the point where they would have gone bust had their friends at Citadel not stepped in and bailed them out, right? So that's the story that's been going around, but it's pretty interesting. It's a world where people are calling it a generational kind of war between the young newcomers to the market who are playing on Reddit and all talking to each other on social media and going after and buying loads of call options, versus the old school hedge funds that are looking at valuation and trying to determine which stocks are a sell. And right now, at the margin, the retail army is bigger and seems to be winning that battle, right? How long this continues is anyone's guess, but it's quite an interesting thing to observe, and it's quite an interesting thing to see. But it's starting to give you starting to make you reminisce about when it was 99, 2000 in the tech bubble and the kind of crazy things were happening. Some of these moves are kind of starting to smell a bit like that, right? Other stocks that have kind of done similar things, Palantir is another favorite of this retail crowd, had a massive rally, probably about 40% rally in the last 2 days. You also got Blackberry that has come on with some positive news last week, and that's gone from $7 to $20. So these are the type of names that are in that space where the retail army is going after them. They're not big caps that are sitting in the major indices. They are the story stocks, but they seem to be, you know, where all the action is right now, and they are catching the headlines for sure. Yeah. Back to sort of broader market and kind of more liquid stuff. I would say the other interesting thing is the VIX. So I always talk about vol being a vol trader. It usually gives you some guide as to what's going on. So the VIX is still around sort of 23 versus a realized volatility of 10. Okay, so that's quite a large premium for implied volatility, which is the VIX, to have versus realized volatility, which is how we're actually moving, right? And when you get that big spread between realized and implied, it is basically telling you that people are buying options. People are either buying call options to play the market to the upside, or people are buying put options to protect their exposure to the market, right? So, and when I say people, I mean the end users, right? So whether it's the retail people or whether it's asset managers who are allocating exposure to equities and buying puts to hedge that. So, and that's also evident in the skew, which is the difference between upside calls and downside put volatility. You can see that the downside put volatility is trading very expensive. Obviously, after the crash we had last March, people are going to be nervous to sell that stuff. So any supply of that stuff that you might have had from systematic sellers of volatility has gone away. And that premium still exists there, where people are still buying it to make sure that they're hedged and make sure that their tail risk is covered. Okay. So when you have a structure like that, generally it tells you that the market is not about to crash, right? So even though you've got quite extreme sentiment on the bullish side, you've got, you know, a lot of people over the last couple of weeks have been talking. I said it in my last week's video that, you know, panic euphoria models, sentiment indicators are all showing very, very bullish extremes, but they're bullish extremes alongside volatility that is not complacent, volatility that is quite showing you that people are paying for hedges, people are participating in this rally, they're bullish about this market, but they're doing it using optionality. They're not short vol, right? The guys who are short vol are the dealers and the banks, but the end users and the clients are buying vol, okay? So when that happens, you think it's even if we get a pullback from these extreme bullish sentiment levels and the market does pull back, because vol is quite elevated, it's unlikely to snowball into a March 2020 type scenario where we come off 30% quickly, right? So if we're going to get any sort of corrections, they're probably going to be more healthy. They're probably going to take markets to, levels like 36, 36.50 on the S&P, things like that are more realistic for a pullback, right? So if you look at this, I've got some levels marked out on the blue horizontal lines. These are my support levels. Between 36 and 36.80 is an area that we could easily pull back to, and we could do it quickly on a bit of bad news hitting the tape. As we saw, we took 2% off the market intraday yesterday. So there's nothing to stop us shaving a couple of 100 points off the S&P. But I think at that point, it's probably going to find support, and you're probably going to start to see the type of headlines that we're used to seeing about more stimulus, more Fed support, things like that. That will stop that turning into anything too sinister. And because the clients are protected and they bought those puts to protect their exposure, they won't need to panic out of the market either, right? In fact, they might have bullets to increase their exposure to the market in that type of sell-off, right? So that's what the structure of the market is telling me. Next, if we talk about the dollar. So obviously the dollar has been a big driver of this kind of reflation trade that's been going on. If we look at the chart on the dollar, you can see, I had mentioned that the dollar was likely to bounce from those levels, showing like bullish divergences on the momentum indicators. We did get that bounce. We got as high as 91-ish, and now we've kind of pulled back, but we've formed a bit of a base, right? So now, it looks, if we break back below 90s, let's say we get to 89.5, then that's probably a rejection, and we're heading back to new lows, and this dollar sell-off continues, and the reflation trade continues, and risk assets rally, right? That's probably what happens if we take that level out. If this base holds, and I've got this trend line here, if this base holds and we go towards 92 in the dollar, then that should provide the catalyst for a bit more risk off, a bit more correction in commodities and equities, the whole reflation trade slowing down a bit. But ultimately, this trend lower in the dollar seems to be pretty intact. And even at 92, you could argue it's just a healthy bounce off pretty oversold levels, and it can resume its downtrend. So we'll potentially be setting up for a nice opportunity for a kind of 2 to 3 month trade to get long risk, to get long that reflation trade again. But right here, right now, I don't think it's a no-brainer to be long that reflation trade. So, I'd say it's a more wait for your opportunity to get into that. Yeah. Gold's in a bit of no man's land right now. So it had its big rally at the start of the year. It had a pullback on real yields popping and bonds selling off. And then lately it kind of tried to attack that 1800 level and bounced. So even in the face of, it seems to have found some stability, even though the dollar has still shown some signs of strength, right? Gold, but like I say, gold is benefiting from the money printing fiscal stimulus narrative. The monetary debasement narrative is benefiting from that. But what it doesn't like is the real yields going higher on the back of a potential recovery in Q1, Q2, right? So that's the tug of war between those two narratives right now, right? But ultimately, even if you get a recovery and you get a bounce and real yields go higher by another 20, 30 basis points, let's say, gold's going to go back down, but there will be a point in yields where they won't let yields go up anymore, right? Because there's too much debt, yeah? And so they're going to have to cap yields. So we don't know where that point is in yields, whether it's at 1.5 or it's at 2, whatever it is. I suspect it's somewhere between 1.5 and 2, yeah? Where the Fed will step in and say, right, we are stopping 10-year yields from going any higher, right? Effectively yield curve control we're doing like they do in Japan. And by doing that, what will happen is if the economy is still growing and inflation is rising, then real yields will tank, basically, right? And when real yields tank, what's gold going to do? It's going to rip higher, basically, right? So I think the path for gold is either gold just goes straight up from here because real yields don't ever go up again. And that was a momentary pop in real yields and they go back down. Yeah. Or gold has a bit more downside to do. Retest that 1760 level that it bounced off back in December, maybe break that level to go to the next one. That would be lovely, because what will then give you a buying opportunity, because you know the inevitable path is that they're going to have to step in and cap yields, and when they do that, gold's going to reprice and rally. It's going to rally aggressively, right? So that's what I think. So right now, no man's land. It's kind of stuck in the 18 to 1880 range. It's probably going to need a move in bond yields to determine where the next direction is there. If bonds bounce and bonds rally, then they'll take gold with it, and gold will go back above 1900. If bonds sell off, like I suspect they still will, I suspect bonds will sell off. I suspect yields have got a bit more room to go higher. So then I'm favoring a retest on the lows on gold at 1760. And like I say, the next level below that is kind of around 1680. Yeah. So those for me are the levels to keep an eye on in gold, at which point I will be re-engaging and increasing. I've got some long-term longs that I've had forever. I will probably add to those longs if we do get down there. And if I'm feeling like we're getting pretty close to that yields getting capped scenario. Yeah. Silver is kind of just going to mirror what gold does, I think, to some extent. So I think it will get dragged. If gold does roll over, like I suspect it will, silver will get dragged down. These are my levels, 23, 22, 20.7. If silver does manage to test any of those levels, I'll be picking some silver up as well. Gold was generally being driven by the same kind of liquidity narrative, right? The stimulus liquidity that was driving equities higher. It was only post-vaccines that changed, because what happened post-vaccines is the bond market sold off, right? So for the second half of the whole of last year, you had equities and gold rallying on stimulus, money printing, all that story, liquidity injection, but the bond market went nowhere, because the bond market was saying growth is fucked, yeah? Like that's what the bond market was saying, right? We're in a shit show scenario for the global economy. Bond market was going nowhere, okay? And then vaccines came out, bond market said yours, right? Yields popped. And all of a sudden, this kind of story has now become one of not stagflation anymore, but reflation, right? And it's the transition from stagflation to reflation that is bearish for gold, right? In a stagflationary world, gold's golden, pardon the pun, right? Because you've got inflation, but you've got no growth. So when you've got no growth, yields go nowhere, right? Yields go nowhere, but you've got inflation. That means real yields collapse, basically, right? If real yields collapse, that means gold goes up, okay? But when you move from stagflation scenario to reflation scenario, because we're actually recovering and we're seeing growth, yeah, that's when gold isn't the greatest hold, to be honest.
Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our summer academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com.